Hey everyone, this is Zach, the broker of Zach Taylor Real Estate. Today we have a special guest. Amanda Rhodes with Concordia Insurance is with us. She is going to be talking about temporary occupancy agreements from an insurance perspective. So she created her own insurance company, and we're so excited to have her at the office today. So shortly, I'll transition into the training video room, Zoom that we did and recorded it for you guys all to watch back. But today is all about temporary occupancy agreements. So I know in this market, with it being a seller's market, as buyers, we're trying to do everything we can to get our offer accepted. And one of those things that we're doing is temporary occupancy agreements. And for those of you that are brand new or unaware of this concept, it's basically a temporary occupancy, exactly how it sounds. So once the property closes, this form in particular allows the seller to live in the home that they just closed on and just sold past the closing date for a certain time frame. So that's what we're dealing with today. A lot of buyers are starting to offer that. However, that does come with risks. One of the examples, and I know it kind of says in this form a little bit about if the seller damages the property or whatever else, but just like Amanda's going to cover in the video, the problem arises when the buyer is now the homeowner of that home. And let's say the seller throws a party, one of the friends that the seller invited over trips on a crack. Well, now it's actually falls on the buyer's responsibility because somebody got hurt on their property, even though they're not even living in there. So that's why I thought it was really important to bring in an expert in the field, especially from the insurance side of it, the temporary occupancy agreement. And if you guys have not seen this form before, it is form RF 627. So this is temporary occupancy agreement for seller after closing. There is also one for temporary occupancy for the buyer prior to closing. That one's not used as much since we're in such a seller's market. Again, my phrase, there's a TAR form for that. So here's the one if you need to implement the temporary occupancy agreement. It's also in our contract on page 4. If you remember closing date, so it says possession will be at closing or as agreed in the attached and incorporated temporary occupancy agreement. So that's what it means when it's talking about that, is this form in particular. So go ahead and read through this and make sure you understand the different paragraphs within this. I'll cover it real quick, and then we'll jump into the video. So temporary occupancy agreement, you either check binding agreement date. So if you're bound and trying to get this signed off on, or if you're attaching in your offer, you would just put offer date of this, the purchase and sale of property located at this address, city, zip, and then buyer shall allow seller to occupy the property until the blank day. So you could say, let's say 5th day of May, 2022. We could say 5 p.m. And this is going to become our possession date. So on the 5th of May, that's when the buyers will actually take possession of the property. So even though we might close today, the buyers aren't going to actually get to move in until at least 5 p.m. on May. And then compensation, seller shall pay buyer as compensation for the use of the property the sum of blank per day after the closing date. So I have seen $50 here. I've seen $100 per day. I've even seen $0. So it's different things that maybe the seller needs a place to stay after closing. This is what a lot of agents are submitting with their offers as, hey, if you submit our offer, we'll help you out with the terms and you can stay in the home. So you can say this, let's just put a dollar figure, $50 per day. Set amount shall be payable from seller to buyer at closing. So this should be handled by the title company. Make sure you bring this up. Make sure it's on your ALTA statements, your closing docs. Make sure it's on there, something to mention it. So you want that to be on there. In the event seller defaults and fails to deliver possession of the property on the possession date, the compensation shall be increased to. So if you don't move out by May 5th, now it goes up to $100 a day versus $50 a day. And shall be payable without demand by buyer. Seller shall be responsible for payment of all costs and expenses. So here's the thing too, and this was a really good question from an agent the other day, but compensation shall be increased to $100 per day and shall be payable without demand by the buyer. So as real estate agents and realtors, that is exactly our role in this transaction. We are realtors, we are real estate agents. We are not debt collectors. We are not attorneys. We do not chase down payments. We are realtors. So that's why it's really important if it moves into this stage that it's really should be handled by the buyer and sellers directly. If not, maybe they might need legal counsel or attorneys involved. But that's where we don't want to get in the habit of, hey, I'm going to chase down this seller for $100 extra a day for my client. Let's stay in our lane. Let's stay as agents. We fill out the form. We help them with the contracts, help them get to close. And that's our lane. So it goes over different things, utilities, insurance. And then here are some additional terms. And I really like this concept from Amanda, and you'll see it in the video. But seller to obtain and provide proof of renter's insurance prior to closing to show insurance coverage for the time period set forth in this temporary occupancy agreement. So just like she mentioned, it's really important that when it closes, the sellers now should get a renter's insurance policy to protect all their stuff as well. They don't need to accidentally burn down the house and then come after you as the new buyer for faulty wiring or something like that. So getting renter's insurance for the sellers. And then I like up here how it says $50 per day, set amount shall be payable from seller to buyer at closing. Maybe adding something like $2,000 to be held by buyer's title company until date of possession, or this amount to be held by the title company. Something in there, some phrasing would help better strengthen your buyers and protect them better legally. But enough about the temporary occupancy agreement, the fun legal side of it. Let's go ahead and hear from Amanda Rhodes from Concordia Insurance. And we are so appreciative for her time. And thank you so much. And I hope you guys pick up something from this video.
Okay, can everybody see me? Everybody can hear me? At least see this. You don't necessarily need to see me, but you can see this. Yes, okay, perfect. So we'll get started. Sorry for the delay, technology details, difficulties, and I got the donuts in the parking lot. It was the whole thing. But they didn't fall out of the box. Okay, so my name is Amanda Rhodes, and I co-own Concordia Insurance with this beautiful lady right here. Jenna, my business partner. We are a female-owned and operated independent insurance agency right here in Middle Tennessee. Our mission is pretty simple. We just want to give customers the best service that we can give them and help them understand their insurance buying power. No one understands insurance. No one. Most people who sell insurance don't understand insurance, unfortunately. I have come to realize that especially since I've been in this business, I've dealt with a lot of, and I became very good friends with a lot of real estate agents, a lot of lenders. No one understands insurance, even the people that see it deal with it every single day. So just trying to teach people just enough so that they can make good decisions and be smart about things. And then we just like building relationships with our clients and referral partners to make that all happen. Again, delay, but it's coming, I think. There we go. So just a little bit about me personally and professionally so that you can kind of get to know me a little bit. I've been in the insurance business for 22 years. I know that seems like a really long time. I'm only 37, so it is a really long time. Been doing it since I was in high school. I sat on the National Alliance Board for Insurance Contracts. So that was a national board recognized in all 50 states under all insurance carriers. And my job was to read and study contracts. So unlike anybody else, I actually like reading those, God forbid, 75-page documents and seeing what's going on in there. I worked in the high net worth space for almost 10 years. So there's literally nothing that I have not seen. I've seen some crazy, crazy things with insurance. And then in my first 7 months of sales, I topped the nation's 1% in producers. So I've been doing this a really long time. And I have no formal sales training whatsoever at all. In my first 7 months of sales insurance sales was 3 years ago. Two and a half years ago.
What do you think to get to that kind of like real estate agents? What do you think helped you get to that level of success?
Knowledge is power.
Okay.
I am not a salesperson. I will never be a salesperson. I don't want to sell anyone anything. I want to teach them what they need to know and educate them. And in doing that, they trust me and then they buy from me.
Perfect.
Period. Yeah, I haven't had one single solitary day of sales training. I went into my first sales position. I was the director of operations, and being an adult babysitter was not my forte. And so my boss, the owner of the agency at the time, and I decided, okay, I'm just going to move into inside sales. I was terrified because I was a single mom with 2 kids, and I was like, sales, I don't know about all this. I'd never done sales before. And so he put me into sales in an inside sales position. And my first month, he was like, let's just try to do $50,000. My first month I did, I think 75. 75,000. My second month I did 90, and my third month I did 150, and it just went up from there. So in 7 months I did $980,000 in new business. So, like I said, mom with 2 boys. Everett is my 14-year-old. Eli is my 9-year-old. I'm pretty proud of them. They're kind of awesome, if you ask me. When I'm not working, which is pretty much all the time, you will find me on the football field or the basketball court. So my youngest plays basketball, my oldest plays football. I grew up on a horse farm in West Tennessee, and I barrel raced as a child. Like competitively won state championships, things like that. So it's a little fun fact that no one knows about me, because I haven't been on a horse in a very long time. I probably wouldn't even know how to ride one anymore. I also run the Herd, which is a female, an all-female charitable networking group in Wilson County. So we have 111 members, I think, right now. And what we do is we get together, we network, we make relationships, but most importantly, we give back to our community. So every meeting we have, everyone makes a $10 donation to a local Wilson County charity. Right now we're collecting money for Wilson County schools, because next month is Teacher Appreciation Month in Wilson County. So we're going to be going to all the schools and doing some fun things for the teachers there, because they don't get enough money or respect or any of the other things. I'm also the city ambassador for Mount Juliet for Tennessee Women Connect. That group is in 9 cities now. There's about 2,500 women that are part of that group. And so I run the division for Mount Juliet. Okay, enough about me. We're going to do some trivia today. Doesn't that sound like fun? Okay. So if they can chime in.
And can everybody still hear okay? Everybody still good?
Yep, good.
Yeah.
Perfect. So a little piece of trivia. What do you think the most expensive house I've ever insured was?
I said, do you only do insurance in Tennessee?
So when I worked in the high net worth space, I did business in all 50 states and internationally.
Ooh, I was like,
20 million.
30 million.
Keep going.
I was gonna say around 15, but I don't think that's high enough.
Yeah, so I worked in the high net worth space for 10 years. My smallest house was about $5 million. My largest house was 40 million. In today's market, it would probably be closer to 100 million from a value perspective. That particular client actually had 2 $40 million houses, one here in Franklin and one in Parker Ridge, Colorado. So one $40 million house wasn't enough. He needed 2 of them. Had a bowling alley in the basement. It's pretty cool. Wow. And his house here had a water slide in it. Not like a pool with a slide, a water slide.
Oh my gosh.
Yeah. Told you I've seen it all. Okay. I promised to talk about temporary occupancy today, the good, the bad, the ugly. I think that temporary occupancy has a bigger chance in the market today than it ever has in my personal experience. And while I'm not in real estate, per se, I obviously deal directly with people buying homes. And so this has become a huge issue and a huge topic. And it's obviously just the sense of urgency around our marketplace right now, right?
Mm-hmm.
Like people are getting in, people are getting out, what are they trying to do, et cetera. So there's 4 main things that I kind of see here is what do I do if my client can't move in right away? What do they need to do? What do my clients do if they're doing some type of major renovation once they get in? Because a lot of times we're buying houses, sight unseen, no inspection, just craziness. What if my seller is waiting on their new home and they can't move into it? And then what if my seller is waiting on a new home in another state, which we're obviously seeing an astronomical amount of buyers coming in from other states, specifically California, New York, et cetera. I deal with probably 3 buyers a week right now that are moving from California with all cash purchases. Oh. So last week I wrote 3 $800,000 homes, all 3 cash buyers from California. So it's definitely an issue. Okay, so unfortunately, I'm not going to give you probably the greatest answer that you'd like to hear. There is no hard and fast rule on this. Typically, with most insurance carriers, anything between 30 to 60 days is totally fine. After that, you start to lose coverages like vandalism, mischievous mischief. So basically, if somebody comes in and does something to the house, you're not going to have coverage for it. The biggest thing here is that your client, you should be advising your client to make sure that they're having a conversation in writing with their agent about what they have going on. All of the insurance companies that I deal with, under their contracts, they specifically say that you have about 90 days before you have to be in a homeowner's contract before you start losing coverages and things start going void. Homeowners policy contracts are designed and written in a way that you live in the home, right? So there's the other option is to get if you know your client is going to be out for more than 60 to 90 days, or the underwriter is just not wanting to budge for whatever reason, there is a product called a vacant homeowners product, but it is expensive and it's not very good as far as the coverage is concerned. It's what you would typically see investors do, what they would have to have if they're going in and flipping a house, right? Once you buy a house, it's vacant, you're doing renovations, you need a vacant dwelling fire policy. And like I said, they're pretty pricey. But the good thing about them is you only need them for the time that you need them. And then once the house sells, you can cancel the policy, the rest of your money back. So let's see. Like I said, you stand to lose vandalism and mischievous mischief coverage, and it is going to be dealt with on a case-by-case basis. So it's really important to just have that conversation with your client and let them know, like, hey, unfortunately, there's no specific rule about this. It's really how the underwriter's feeling that day, because it's they have the ability to note the file, give grace, give extensions to what the actual policy contract says, and no one else, even your agent, can't do that.
So you're saying normally up to 60 days is okay. Anything beyond 90 is
yeah, anything after 90, again, depending on the carrier, all of my carriers, I'm not for sure on your State Farms and Allstates, your captive markets of the world. But as far as your independent or non-captive markets are concerned, I think I've pretty much did business with just about all of them at some point in my career. And I can tell you that their contracts all read the same way.
Okay. Yeah, because I was talking with, I know Grant's on here and he can chime in if he wants, but Sean was mentioning with the Kaplan team that anything over 60 days, you guys now have to underwrite it for a mortgage perspective differently and view it as an investment home instead of just a traditional purchase.
Yeah, the Freddie Mac and Fannie Mae have changed guidelines like crazy as far as second homes and investment properties go, especially with rates increasing. We're seeing pricing get crazy on those. So we're seeing the second home market go away completely right now.
So that's the biggest thing is why I brought in Amanda and stuff too, is when we're doing these temporary occupancies, kind of avoiding that, hey, 90 days, 120 days, sellers just saying, hey, we need months after, that's where we start to get in trouble.
Yeah. And, obviously, depending on the circumstance, you can see that no matter what the case, but I tend to see that a lot for people that are moving again, cross country. I have a couple right now that's buying a house. They bought it yesterday. Actually, they closed. They're coming from California, I believe. And they're not going to be here until the end of July. So, yeah, you have to work on some things there. And I didn't realize that it made a difference from a mortgage perspective, but that does make perfect sense because mortgages work the exact same way insurance policies do. They're designed to be resided in, right? Okay. So let's see. Okay, this one, so here we're talking about if your client's doing major renovations to the home before they move in. We're not talking about cosmetic, I'm changing the flooring and doing paint. That's no problem, there's no issues there. No conversations need to be had. That's going to be totally fine under any policy contract. But when you have a client that is doing some major renovations, again, same thing. Typically with most carriers, anything between 30 and 60 days is fine. Again, conversations in writing is super important. Your renovations have to be improved by underwriting. And if they're extensive enough, again, it's going to change the type of policy contract that you need. So homeowners policies are also not designed to be having major work being done and workers coming into the house constantly and, flammable materials being left in the house because of the work and things like that. So if the renovations are drastic enough, and typically I can tell you that the guidelines around that from an underwriting perspective are if you're moving any walls, if you are adding square footage of any kind, anything like that is going to be considered excessive renovations, and you're probably going to need a builder's risk policy on that property until the work is done, and then it could be converted over to a homeowner's policy. Again, those are a little bit more expensive than your typical homeowner's policy, not nearly as expensive as the vacant policies, but the good thing about those is same thing. You can cancel them after you are done moved into the property, and you don't need them anymore, and you can get your money back on them. Another thing that's huge, and I think a lot of people don't realize, so kind of whispering this in your clients' ears, is anytime you are having work done on your home, and this goes for you guys too as homeowners, if you are having work done on your home, it is really important to get certificates of insurance from anyone that you're hiring to come into your home to do work, especially when you're doing major renovation stuff. The largest claim I've ever had was $14 million. It was a $7.5 million home that had just been built in Brentwood. She got her certificate of occupancy 2 weeks before the loss. So they finished the house. They had an professional interior designer come in and furnish the entire home. So it's $7.5 million house with $7 million in contents coverage. They came in, they did everything, they moved in. 2 weeks after they got their occupancy letter, she decided that she wanted to have the attic space above the garage finished so that she could use it as storage. So she hired a third-party spray foam insulation company to come out and spray foam the inside of the garage, the detached garage above the attic space above the garage. There were some halogen lights hanging, and for those of you who don't know, spray foam insulation is highly flammable for the 30 seconds it takes for it to go from the gun to the wall and set. Sparks burnt down the house, the garage, everything. It took the insurance company 3 years to settle that claim. And the reason that it took so long was because the company who sprayed the foam was not insured properly, and she did not get a certificate of insurance, and so they were out of the question. Then it went back to the builder. The builder filed bankruptcy and went out of business. So there was nothing left to subrogate at. We went, down the line of people, and it just came back to the insurance company. So Fireman's Fund paid out $14 million loss for that. So very important to get a certificate of insurance and make sure that the person not only has insurance, but has sufficient insurance. If you have a $3 million house and they have $1 million limit, don't let them work on your home. Okay, so as sellers are waiting for their new home, they're probably going to need renter's insurance because they sold their own house. So they don't have a homeowner's policy for that anymore because it's gone. They have all of their stuff still, and they're not in their new place yet. So a lot of times you'll see people will rent. I'm seeing people rent Airbnbs. I'm seeing people stay in hotel rooms. I'm seeing people stay with their family. If they're moving from another state and they're moving here to be closer to family. In all of those situations, their contents coverage need renter's insurance. And a lot of people also think, oh, well, I've got my second storage, so it's fine. Your contents coverage actually only extends 10% to contents and storage, which is typically not nearly enough, especially if you have your entire life in a storage unit while you're waiting on your new house to be ready. So renter's insurance is important for that situation, just because we have a lot of weather and things here. And I have seen situations where storage facilities have been hit, pretty badly, and clients did not have the coverage that they needed to have. Your client should also be having conversations. Again, I think it's really important to always get major conversations like this in writing, because your agent is just your agent. They're just kind of like you guys. They're the broker. They're the person in between the carrier who's actually legally responsible for your contract and your loss and you. So if they give you wrong information and it turns out you have a loss and you don't have coverage, their errors and omissions policy would kick in and pay for their error, assuming that you can prove that you were wrongfully informed. So it's always important to have conversations like that in writing. Especially if you're moving cross country and you're coming to a new carrier or agency, which is typically the place. A lot of clients, I've had a couple moving from New Jersey, and they have New Jersey manufacturer's insurance. They don't write in the state of Tennessee. Same thing there's several markets in California that we do not have here in Tennessee. So you're not only moving across the country, but you're also having to move agents and carriers. So those coverages are not going to translate properly. California's laws are very clearly different than ours. And our contracts are written according to Tennessee laws, not to California laws, and vice versa. So it's important to have those conversations.
With the renter's insurance, because I know right now we're seeing a lot of sellers are moving, but they have to stay in the home they just sold for maybe like 30 days before they close on their next home. Is that something where maybe for our agents, they need to be putting in that contract if the seller's going to be staying, like we need proof of renter's insurance
Yes.
from them for their contents?
Yes.
Okay.
Not only so much as their contents, your person really isn't concerned about whether their stuff is protected or not,
Or their
but
house.
right. The person who owns the property officially at that time, if they have a tenant, which is essentially what that person is in that house at that time, they have a liability there.
Mhm.
So if the tenant doesn't have liability insurance, which they can't have if they don't have renter's insurance, if something happens on the property from a liability perspective, if they have a going away party because they're moving away and they have all their friends over, someone has a little too much to drink and falls down the stairs and breaks their leg or breaks their neck, guess who's responsible? The homeowner. And if the tenant doesn't have liability insurance, then that's going to be an issue. So yes.
Yeah.
Yeah.
So that's just kind of something that, like, as our agents are writing contracts, if the seller has like a post occupancy, that's probably something that needs to be included, like just saying like, hey, you're buying this house. Let's make sure that they have renter's insurance, and
Yes,
liability insurance.
I would recommend that they have renter's insurance with a $500,000 personal liability. Personal liability comes in $300,000 or $500,000. Typically, those are the two biggest common amounts, and the difference between 3 and 5 is about $20 a year. So it's extremely minimal. So that's what I would recommend that you do.
Question. We do have on our temporary occupancy agreement that the seller, if they're staying in the home past and they're becoming the tenant, that they're responsible for anyone who's hurt on the property or anything like that. So would
It's not
that
like
not
that.
hold up in an insurance situation? Okay.
Would absolutely not.
So the seller couldn't sue them for it if
They could, yes, but
it'd just be a mess.
it would be. And in the world of insurance, the contracts are pretty straightforward. And the number one rule of insurance is you can't insure something you don't own. So if you don't own it, you can't insure it, right? I can't insure your car. I can't insure life insurance for you. I can't insure your home. So yes, it wouldn't hold up in court.
So if they get liability, if the tenant gets liability insurance, it will.
Yes, so the tenant, the way that would work is the tenant's liability would be primary, and then the owner's liability would be secondary. So depending on what happened, and this, again, it's anytime you have a claim, fault is determined, whether it's an auto loss, a home loss, whatever. So let's say in your situation, the seller that is still residing in the home has a German Shepherd. And the German Shepherd, between the time of the sale and the time of them moving out, bites a new neighbor child. So obviously the neglect there is on the tenant, the seller of the property, right? But it's also on the owner of the property, because the owner of the property maybe he didn't have a formal lease in place, allowed the dog to be there, whatever the case may be. So you're going to see some fault in both parties in a situation like that for sure. If if the seller has somebody come over and there's a crack in the sidewalk and they, trip over it and break their leg, well, the new owner is going to be responsible for that, because technically that's their property. And these people are now tenants, not, even though they just sold the house yesterday and the crack was there yesterday, they're not
At fault.
Yeah, they're not the owners anymore. Those people are. So yes, it can get very tricky, which is why I recommend renter's insurance is like $200 a year. And again, once you sell, once you're in your new property and you don't need the insurance anymore, you can cancel it the rest of your money back. But certainly worth the $200 that it could arise from. Okay. Oh, it's a little more trivia. What do you think the most expensive piece of jewelry I've ever insured was? Single piece, not
Does a watch
a
count?
lot. Yes.
I'm gonna say a watch.
Okay, but
What's
how
so
much?
expensive
How
about
much
this?
was it?
Oh,
$2 million.
Okay. It wasn't a watch and it wasn't $2 million.
$5 million.
Close. So the most expensive piece of jewelry I have ever insured was a ring that was valued at $3 million. The ring was designed by a jeweler in New York, and it was shipped. When I say shipped, I mean flown on a private jet to Nashville to its owner. It resides in a vault when she is not wearing it. And when she does wear it, which is typically just one time a year to a special ball that we have here in Nashville, it is brought to her home in a Brinks armored truck. and she is then escorted with armed security for the night. So I wasn't kidding when I say I've seen it all. Yeah, beautiful ring, but somebody would chop your arm off for that and not think twice
How
about
big
it.
is this thing?
It's about that big around.
Good Lord.
It's just a solitary one stone. Yeah. Yes, 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 a diamond. Yes, it is a diamond. A very large diamond. Oh, do we have a question or is that?
No, that my phone is hooked up to the computer.
Oh, gotcha.
Sorry.
Okay. Does anybody else have any other questions before we move on? Temporary occupancy, the crazy things I've seen, whatever. Do we have them on mute or can we hear them if they say something?
No, they can-
You should be able to hear them.
Okay.
Unless
just
they
wanna
have
make sure I'm
themselves
not-
muted.
I just
Yeah.
want to make sure I'm not like just rolling through here and somebody's got a question and I'm not hearing them. We're good?
I guess we're good.
Okay. All right. So I also promised to do a little homeowners 101. And this is just as much for you guys as homeowners yourself as it is for your clients. It's really important to know, again, education, knowledge is power in what I do. So we're going to pray that this stays connected for me to do this. Okay. Woo-hoo. Okay. Hopefully everybody can see that. Okay, so this is a insurance quote that I did last week for a client who lives in Franklin. They came to me from USAA. And so right now their home is $600,000 underinsured. So right now their coverage amount is right at $600,000 less than this, so about $1.4 million. So he came to me and he wanted to get quotes, and I ran his replacement. As soon as I looked at his house, I was like, well, I can tell your house is underinsured. But after I ran all the reports and did all of my investigation work, I realized that it was about $600,000 insured. So every deck page that you're going to see, yours, your clients, if you happen to see those, is going to look very similar to this. I chose Safeco because they kind of make theirs really pretty with all the pictures and lining up all the, it's very nicely laid out. But the meats and potatoes of this are going to be on any deck page that you ever see, including your own. So the first thing we have is your dwelling coverage. So again, $2.1 million. Other structures is anything that's not physically attached to your home. Driveway, shed, retaining wall, fence, pool house, whatever the case may be. It's an automatic 10% with this particular carrier. Some carriers do 20. It just depends on, how they've got their stuff set up. But in this particular case, he didn't need any more than that. He really didn't have many other structures. So $210,000 was plenty for him. I did not increase that coverage. Personal property is anything basically you're moving inside the house, from your shoes to your handbags, to your clothes, to the food in your cabinet, to your furniture and electronics. Personal property for this carrier is 50%. So just over $1 million. Additional living expense. The most important coverage besides your actual home coverage that you have on your policy. If you don't pay attention to anything else I say today, please listen to this. We live in Tennessee and we have tons and tons and tons of weather here. That coverage is what provides coverage to you and all of the additional expenses that you incur if something happens to your home and you cannot stay there due to a covered loss. So I live in Mount Juliet. And for those of you who are local here, you know that we got hit really bad in the tornadoes in 2020. I had a client there who had an $800,000 home that was almost a total loss. So real estate agents, both of them, husband and wife, real estate team, and they ended up using their additional living expense coverage because they could not stay in their home. They bought a property in Jackson Hills, which is one of the nicest neighborhoods in Mount Juliet. They lived there while their home was being repaired. They used the additional living expense money to pay the mortgage every month for almost a year. And then when they moved out, they converted this home into a rental. So they got about a year's worth of mortgage paid by the insurance company, and now have a great investment property that, will make them money for years to come. So very smart on their behalf. But it also covers things like if you just need to stay in a hotel room for a couple of days because the power's out and it's July and it's 120 degrees outside. It covers things like the renter or the movers coming in and boxing up all your things and taking them to storage because you've just had a total loss on your home and they need to get in there and be able to work and not, be working around your things, right? So very important coverage. Again, personal liability, we kind of talked about this just a minute ago with renter's insurance, $500,000. Medical payments. Medical payments is, I call it the good faith coverage. So if I'm over at Zach and Taylor's house, and we're friends, we're just having a barbecue, and Taylor accidentally left the water hose laying out in the middle of the yard, and I tripped over it because I didn't see it and broke my leg. She feels bad because I broke my leg. I feel bad because I broke my leg. She's like, oh, I want to take care of it. The medical payments is going to go towards that. I don't want to sue her because we're friends. If I sued her, it would automatically go into the liability section. But we're just going to try to get it covered underneath the medical payments portion. And then if there's an overflow of that, because nowadays medical $5,000 isn't going very far, it automatically goes into the liability. So it's just an overflow there. So it's just kind of the goodwill. Hopefully we can get this taken care of coverage. This kind of breaks it out. This kind of just goes over what we just talked about, what a dwelling is, what other structures, what personal property is. And this is how I go over every single home quote that I do. Line by line, I explain every coverage. If I can't get the client on the phone, I do this by video and then send it to them so that they have that and they can watch it as many times as they need to with their spouse, whatever the case may be. Again, it's really important for me to be able to educate our clients on what they are getting and what maybe they're not getting so that they can make those educated decisions. In this particular case, he has a $5,000 deductible, which is very in line with his dwelling amount, $2.1 million house. Okay. This particular client has a jewelry schedule. So he's got a $10,000 jewelry blanket. And then down here, no, where is it? Right there. Valued. He's got $71,000 in scheduled jewelry as well. A couple of watches and things like that. Water backup, sewer backup, water for building and contents. This is water backup coverage of sewer and drains is how we typically see it referred to. I do not know why they call it water backup. It is not water. It is sewer. It's gross. It stains everything it touches. It's disgusting to have cleaned up. It's environmental. Most policy contracts do not include this. It has to be added by endorsement. So he's got coverage for that, $25,000. Sinkhole coverage, also a very important coverage here in Middle Tennessee. We do have sinkholes in Middle Tennessee. I don't know if anyone listens to the news or pays attention, but just a couple of months ago, we had a sinkhole open up under the new 6 City Star track here. And they had to shut down the track and the train for however long it took them to get everything structurally back together and get it reinforced and all those fun things. So as you can see, sinkhole's not cheap because it is a large exposure here in Tennessee. I think it's $735 for him, but it is an important coverage. It's also an optional coverage. This particular client actually chose to take it off of his policy, which is totally fine. Again, it's only my job to educate them on what they have and what they don't have and why they may need it. And then it's their decision going forward. So we ended up taking that sinkhole coverage off. This is a very important coverage as well, extended dwelling coverage amount. So in insurance, typically you have your replacement cost, which again on this policy was $2.1 million. And then you're going to hopefully, if you have a good insurance company, see what they refer to as an extended replacement cost. You're typically going to see 20%, 25%, 50%, or a guaranteed /100%. This one is 100%. So in the event that this client had a total loss, and for whatever reason I didn't do my job well, and the $2.1 million is not enough to replace their home to like kind of quality, or maybe I did do my job well and lumber just happens to be $30 a stick that day, this policy is going to kick in and it's going to pay an additional $2.1 million should he need it. So it will double his insurance coverage essentially. Very important coverage to have, especially in today's market, because we never know from day to day what costs are going to be. With the supply and demand chain issues that we're having, everything is taking longer, which is more expensive in general. And then it's really hard to get, the products and things that we need to actually get the job done. Refrigerated products coverage, not really a big deal. Loss assessment coverage. If you live in an HOA, you need to have loss assessment coverage because the HOA has the right to assess each homeowner or unit owner. It doesn't matter if it's a home or a condo or a townhome. If there's an HOA, the same coverage applies. They have the ability to assess you a portion of their deductible or a portion of the loss if something happens to a common area or common piece of property. So if the pool house gets taken out by a tornado and they file a claim and their deductible is $50,000, they will assess each unit owner or homeowner a portion of that $50,000 deductible to pay it. Okay. A lot of people do not know about this. It's kind of the unspoken insurance thing, but matching coverage is not covered under your insurance policy. So if a storm comes through and you've got a tree that's close to your house and it damages a trim, a limb falls off and just damages a 5-foot section of your roof, and the insurance company comes in, it's their job to fix that 5-foot section of your roof. It is not their job to make sure that that section matches the rest of your roof. So if your roof is 10 years old and they no longer make that shingle anymore, they do not have to replace the whole roof just so it aesthetically looks nice. They do if you have this endorsement. So this endorsement gives you coverage for siding, roofing, windows, etc., so that everything matches and looks aesthetically pleasing, even though everything wasn't damaged in whatever the loss was. Personal offense coverage is personal injury coverage, defamation of character, all the, if you get on Facebook or somebody else gets on Facebook and says something they're not supposed to, that's where personal injury or personal offense coverage comes in. We talked about the jewelry and how they have that. And then all of my policies, every single policy that I sell is a replacement cost policy. There's replacement cost on the dwelling, the roof, etc., with no exceptions. Now, that is not the case for all insurance companies. All policies are not made the same. I think people look at the dwelling amount and the deductible and the cost, and then they're like, oh, that one's better, or oh, that one's better. There are so many things that go into a policy contract that you don't see in those 3 numbers that make a huge difference. And one of them is the roof coverage. I have a friend right now who is with State Farm, and she had roof damage to her roof, and State Farm, she has a $10,000 deductible, first of all, because it's a percentage deductible that she didn't know she had. So she's got a $10,000 deductible. And then on top of that, State Farm is only wanting to patch her roof instead of replacing her entire roof, even though the roofer, the contractor that she has, is telling them that it needs to be replaced. It's not structurally sound anymore. They're depreciating the roof based on how old it is, which is the problem. So I would say that probably close to 70% of insurance companies in today's market have a roof depreciation clause. So it's very important that you know this about your house and your property and what your policy states. So if you have a home that's 10 years old and it's going to take $20,000 to replace your roof, the insurance company has a roof depreciation or an ACV roof policy, they're going to come in and they're going to say, okay, it's $20,000 to replace it. You've got a $2,000 deductible, so now you have 18, but it's 10 years old, so we're depreciating $8,000 out of it. So now you only get $10,000 for your $20,000 roof, and now you have to come up with the difference. Okay. So it's really important to know that and kind of have it in your mind of what you're doing, so that at least you have a backup plan, savings, things like that in place if that were to occur, so that you've got coverage for that and you're not in trouble when it happens. Let's see. That's pretty much it on that one. Talk about the cost of that. Anybody have any questions?
No.
Very interesting stuff, right?
No, it's very helpful though.
I've done this twice now, going over a deck page with people. And then it never fails that I get a lot of questions after the fact of, I don't think that covers, my house is covered right. I don't think it's insured right. And like I said, insurance is hard, and it is super complicated as far as the contracts, and it gives and it takes away, and then it gives and it takes away. So if any of you guys have any questions on your particular homeowners policies and you'd like me to take a look at them, I'd be happy to do that. Taylor and Zach have my contact information, and I'm happy to just look at it and tell you, hey, you're missing this, or you might need to look at this, or whatever the case may do. I do it literally every day. So
I guess with like the depreciating aspect of certain insurance companies, so that's probably for more than just the roof. Like, would that be if you have like a fence or siding damage?
No,
or is it mostly
no,
just
they're
roof?
not allowed to do that. So
Okay.
it's only on roofs.
Okay.
But another interesting thing that, like, I know Liberty Mutual does is you have replacement cost on your structure, but they don't give replacement cost on your other structures, which
Like shed, exterior.
or detached garage in my situation. So obviously I'm not with Liberty Mutual, but my neighbor was. And when we had the storms in 2020, like exactly a week later, we had the straight line winds that came through, and I had a tree about this big around in my yard that fell and smashed her garage right in half. And she was with Liberty, and they did depreciation on her detached garage because it was considered another structure. She didn't have nearly enough insurance coverage to cover that. I felt terrible. By the way, there's no liability in that. I had zero liability in that. My tree was not dead. It was just a storm that came through. And so even though it was on my side and it smashed my fence, but it just pulverized her garage. I had no liability in the issue, but I felt so bad because she was my neighbor and we were super close. So I ended up actually helping her make the difference from the insurance difference and help pay to get her garage replaced. Just because it was the nice thing to do, the right thing to do, I felt like. But from an insurance liability perspective, you have zero liability there unless they can prove that the tree was dead and that you knew the tree was dead. You have no liability.
Yeah, because Zach and I actually dealt with that issue with our house in Florida. The lot behind ours was actually owned by the city. And we woke up one morning and our entire fence was, destroyed, and we had this massive oak tree in our backyard. And when we called them, they said, well, the tree wasn't dead. There was nothing wrong with it. We just had a really bad, I think it was actually a tropical storm that went through. And they told us, they said, we don't have to pay to replace your entire back fence.
Yeah.
So
yeah,
it's
the good thing about that is that the tree fell on your fence, which is a covered piece of property. So your policy not only paid to have the fence replaced, it also paid to remove the tree. Fun fact, if that tree would have just fallen in your yard, your insurance policy would not have paid to have it removed because it didn't damage any covered property. So then you would have had to pay to have the tree just removed from your property, which is expensive.
Luckily, the city came and removed the tree. They were nice enough to do that.
Well, that was nice.
Yes, they were nice enough because
That
it was also in their property as well. So they were nice enough to remove the tree, but like the fence, they wouldn't cover the fence. And we were at the time really confused, like, well, but it's your tree. It fell on our property and broke our property. But they didn't know that.
That's not the way insurance works. Yeah, so there's a little fun joke that goes around insurance that if a tree falls in your yard and it doesn't actually fall on anything, just like go put like a chair or something underneath it really fast so that you've got coverage to remove the tree. Because if it falls on your driveway is another structure that's covered. But if it just falls in your yard and nothing else, then there's no coverage and you have to pay to have it removed yourself. And I don't know if you've ever priced tree removal, but it's expensive. It's very expensive. What else we got? Okay, so we already saw the declaration page. Okay, so as the agent, especially when you're selling a home and you're working with your buyers, there are a couple of things that I would recommend. Not that any of this is really in your control, but I think, again, knowledge is power. And so if you kind of know this, especially if you're working with a buyer that maybe has a DTI issue or something like that, where you're kind of, you're just skating in the line and you know exactly where you have to be and everything's super close. The age of the roof and the year of construction make a huge difference in premium. Okay. Especially the age of the roof. I can run a quote for you on a brand new construction home with a 2022 roof, and that policy might be $800 a year. And then I can run the same exact policy for you, if it were 5 years down the road and now the roof is 5 years older, and it's going to be much different. And then fast forward that 15 years down the road, and you're probably looking at, I don't know, $600-700 difference in premium. So substantially, roofs make a huge difference in premium because it's the most common thing that's damaged. They're expensive. The coverages, the insurance industry itself is really tightening its reins around that thing. I know dreaded flood insurance, God help us all. If you've ever sold or worked with a property that's in a flood zone, then you are feeling my pain in this situation. That's a whole other topic for a whole other class, but flood insurance is a monster all in its own. If you are selling a property that is in a critical flood zone and you can do any due diligence ahead of time, my number one thing would be to tell you to make sure that there is an elevation certificate for that property. The elevation certificate If the property is positively elevated, which is what that elevation certificate tells us, if we have ground zero here, the elevation certificate tells us if the house was built up here or if the house was built down here. If it's built down here, it's not good. Not good at all. An elevation certificate, I've seen it go from a $10,000 quote to a $2,000 quote because someone got an elevation certificate and it just so happened that the property was positively elevated. So very important. Those can make a huge difference. Another fun fact, again, flood insurance for another day. Every single property is in a flood zone. Your house is in a flood zone. Your house is in a flood zone. Yours is, mine is, all of yours are. The key to that is it in a critical flood zone or not? If you're in a critical zone, then your mortgage company is telling you have to have flood insurance, et cetera. If you're in a non-critical zone, you don't have to, but every single property anywhere is in a floodplain. Critical zones means that they have flooded in the last 100 to 500 years. Insurance scores. Insurance scores are basically a loose interpretation of a credit score, and they make a massive difference from an insurance perspective. I could run a quote for Zach and Taylor's house and give them a price, and then I could run their house in my name and the insurance would be completely different. Everything about it would be different. I could take your house and move it to Wilson County and quote it for you, and it would cost differently than it does in Rutherford County or wherever it is that you guys live. But insurance scores make a huge, huge difference. I cannot see them. They don't run credit. So it's not an impact on credit scoring. People always freak out about that. Because they're like, no, my mortgage company told me not to touch anything. Don't worry. It doesn't do that. It's just a loose interpretation of credit scoring for insurance scores. And the reason behind that is very simple. If you have a good credit score and you are financially responsible, that means that you are more financially responsible, which means you're not going to turn in claims as often. You're not going to turn in a claim that costs $1,025 when your deductible is $1,000. Don't do that, by the way. It just makes a difference. And it's proven, statistically proven, that people with better credit scores are just less likely to turn in claims and have issues, payment issues, things like that with the insurance companies. So that's why that is. Another piece of advice that I can give you, no matter who you are insured with and who your agent is, if you do have an agent, if you're not with a captive like an Allstate or a Geico or someone like that, where the only choice you have is to call an 800 number, if you ever have a claim, pick up the phone and contact your agent before you turn in the claim. So important. I see clients come every day to me, typically from State Farm, and they'll have a claim that's open with nothing paid out. And I'm like, you have a claim on so-and-so date. What happened? Oh, no, I didn't have a claim. I just thought I had roof damage, but it turns out I didn't. No, you have a claim. It's still a claim, even though nothing was paid out. So have the conversation with your agent. Let them advise you on what to do before you actually contact the insurance company, if you have that ability to do that, because no matter what you do, once you contact the insurance company, there is a claim on your record, period, and it stays there for 3 years. Okay. All right. Oh, one more piece of trivia. Wow, this is taking a long time. What do you think the most expensive vehicle I have ever insured was, and how much was it? This is a fun game, isn't it?
200,000?
How much?
200,000?
Oh yeah, no, nowhere near. Way higher.
Wow.
2 million.
2 million on the money. A 2000
It's like an antique car, right? Or no?
A 2018 Porsche 913 Spider. So for those of you who don't know, Porsche came out in 2018 with 918 hybrid Porsches. And these vehicles had 2,000 horsepower. The owner was, he flew to Atlanta to have his bottom, he molded for the seats. They took a mold of his, you heard it here, folks, you heard it here. They took a mold of his bottom. I would say something else, but I'm being recorded. And they made the seats specifically for him. And they did that with all 918 owners. The key to this is, again, 2,000 horsepower. So very quickly, 918 Porsches became less and less and less and less, because people can't drive, and they can't drive with 2,000 horsepower behind them either. So they kept wrecking them, which made the existing ones even more valuable. So less than a year later, the vehicle was already valued at about $4 million.
Wow.
Yes. So
For
Um,
Porsche.
for a Porsche.
They claimed that.
I know, right? I think they did. I think they did too. So this particular, so another little fun fact, all of these that I've told you about today, with the exception of the jewelry, the houses, the cars, was all one family. So I insured this entire family. There were 4 siblings and then 3 generations that fell underneath them that I insured the entire umbrella family. They started a very well-known retail company, which I cannot mention because I signed an NDA, but they had 3 generations of just, wealth that there was one person in the entire 3 generations that had a job, an actual real job. Everyone else just did whatever they wanted. And don't get me wrong, they did a ton of philanthropy, the word that you give your money away. Help me.
Philanthropy.
Thank you. Man, that was a hard one. So they did a ton of that, and nicest people we've ever met. But $50 million Gulfstream that was personally built for him. 2 $40 million houses. He had a pair of $100,000 cufflinks that he lost one time.
Gulfstream, isn't that a camper?
No, it's a
That's
plane.
a
Okay.
jet.
Well, no, but there's also the Gulfstream camper.
There
too, so
are.
I was like,
That-
wait a minute, please
those-
don't tell me that's a camper.
Those are Airstreams.
Airstreams, okay.
But
There we go.
Gulfstream, yeah. So,
It's just so much to know about planes.
but like I said, literally the nicest people. I went to every single one of their homes as part of what I did. And one of them had a place out in Ashland City, and him and his wife built that house. And when they built it, this is my favorite insurance story ever. So when they built the house, they had pine hand-sewn floors put in the entire place. So pine has the knots in it, right? And in every knot in the house, they had a trinket from their life together put into the floor before they lacquered over it. So when you walked through the house, one of them had a Mardi Gras baby from a king cake, and that was their first Mardi Gras together. There was a fishing lure in one of them because him and his grandfather went fishing all the time together, and that was one of the lures that they had. There was a pocket knife in one. But so you went through their house, which told the story of their 30 years together. Coolest thing I've ever seen. So that is by far the coolest insurance thing that I have ever seen. That was pretty awesome. What else we got? I think that's it. It is. That's all I got.
All right.
I hope that was helpful. Like I said, if there's any questions that anybody has that they didn't get a chance to ask, will you share my contact information with everybody? Do you mind?
Yep.
So I'll have, they'll send out my contact information. You guys are more than welcome to, contact me with any questions or anything like that you have. And of course, I would love to help any of your clients that, are looking for insurance and things like that. But really just want to help educate the world of what's going on from an insurance perspective, because it is my experience that most people just don't understand it very well. Thank you.
Thank you so much for coming on.
Absolutely.
Thank you.
Thank you.
Thank you. Thank you guys for joining us on Zoom.
Does anybody on
Very good.
questions?
No?
Did they hear me?
Yeah, they're here.
Okay.
They're good. All right. We will see you guys next time.
Thank you.